Hello there, this is James and you're watching Tixee Live. And a very good afternoon to all of you, and all of you a very happy Tuesday. In today's program, I want to talk about a subject which I've discussed a little bit in the past about, and whether or not the market has got itself into a bit of a false sense of hope, so to speak. And a couple of other factors and other things which are happening, including a build-up to a massive event happening tomorrow. But before we get started, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, like I said, I've called this little video "Summer Loving," in honor to a certain person yesterday as well. But anyway, also about that, this has been quite a strange summer for the market. Like I said previously, July was an incredible month of all the things happening, which is very rare to happen in a summer period. Because usually the market sort of goes down. But we've seen an awful lot of volatility, a lot of action, and a lot of stories develop, which is continuing for the month of August. But the question I want to ask, and it is an open question, I want to ask, because I've spoken about this subject before, whether or not the market is just simply enjoying a bear market rally. And in particular, I want to look at the S&P 500 in particular. Okay. Now, what is a bear market or bear market rally, shall I say? Well, obviously, we know what a bear market is. A bear market is when the market is nervous, okay, and obviously the market comes under pressure and it heads in a downward trajectory. Whereas a bull market, the market is optimistic and the market starts to rise as people start to buy. A bear market rally, though, is a rally which happens in a bear market but goes in the opposite direction of a bear market. In other words, the market is bearish, but we see for a short period of time, or for a certain period of time, a rally in the opposite direction, which is a false rally, which eventually comes to an end, and the market continues its normal bear market direction. And I want to ask this question: is the S&P currently enjoying a bear market rally? And if it's enjoying it too much. Now, the S&P, okay, since hitting the lows in June, its yearly lows of June, it has recovered about 13% since that point in June. So it has recovered. And don't forget, I said on the very first video of August I did, that July was indeed the best month for US equities since November 2020. And as well as that, so far, Q2 earnings have been fairly robust, okay? In fact, 77.5% of the S&P 500 companies have beaten earnings estimates. The likes of Google did extremely well. Microsoft was extremely better than expectation. Apple was as well. So what makes me say, so we've had the best month in July, best month since November 2020, James. Obviously, S&P 500 has got off, risen 13% since the lows in July. So why are you asking, since June, sorry. So why am I asking the question, is it simply enjoying a bear market rally? And the reason why I want to ask this question is because I think it is. And I'll tell you why. Why I think that is because I think, at the end of the day, the market is not really taking into account the recession fears, which is still very much there. I know we had a very good job number on Friday, and like I said on Monday, I'm looking forward to seeing what the revised number is next month. But anyway, yes, okay. But we seem to forget we are bordering on, or we do have real strong recession fears. As well as that, the market seems to have forgotten how aggressive the Fed is, how much the Fed is going to do in the future, okay? Because the press conference 2 weeks ago and the monetary statement 2 weeks ago was taken as so dovish, where in fact it wasn't. They have not stopped or changed their mandate about raising interest rates and getting to certain levels of 3.75 to maybe 4% by the end of the year. But the market seems to forget that they are. It's okay. They're going to be easy. And the question I have to say is the impact these higher interest rates are going to do on the market. For example, a couple of things today, and like I say, S&P is trading lower today. There is a couple of things. There was two chip makers in particular, NVIDIA, Macron, have all warned they're going to miss their revenue forecast. In fact, NVIDIA, I think that's how you pronounce it properly, my error, they said they're forecasting their profits around about 6.3 billion versus the expectation of 8.3 billion. So 6.8 billion down from the expectation of 8.3 billion. And that's quite a big miss. That's quite a big miss. And the reason for this, they're putting it down, is a decline in the gaming market. Okay. And Macron today is another company, which has said, another chip maker, which is saying it's going to miss its forecasted revenues. So, yeah, already there is, it's not a totally gloomy, totally rosy picture. And the other thing I have to say, I have to point out, don't forget the Fed has been extremely aggressive rate hikes over the last couple of FOMC meetings. Okay, they've raised rates the highest amount in over since 1995. Okay, it was the last time they raised rates by 75 basic points. So we're talking about a long period of time, and we have not yet, the effect of tightening. And what I mean by tightening is increasing interest rates. Okay, we haven't seen the impact that has had yet, or will have, on the market. Because don't forget, when you raise interest rates, okay, it raises the borrowing costs of loans, mortgages, credit cards, and every other type of finance. Okay, and it's not just for individuals either. You're talking businesses as well, companies who have borrowed loans. It's going to make a difference to them as well. So we haven't priced this in, or haven't taken this into account in any way a bit at all. Not at all. So we haven't taken that into account at all. And like I say, the US, excuse me, the US is counting on, obviously, energy is dropping in prices to help, the day-to-day individuals from affording to run their cars and etc. Things like this. That's what they're sort of pinning their hopes on. But like I say, it's the other costs, and it's the knock-on effect of all the other logistic costs for companies, which they're not simply because the petrol price is going to drop. Costs are going to be cheaper for companies either. That's not going to happen straight away. And don't forget, yes, I just said earlier on about obviously 77.5% of the S&P 500 companies beating earnings estimates. But don't forget at the same time, Google, Apple, Tesla, and Microsoft have all said they are looking at slowing down their hiring process and maybe looking at layoffs. So maybe the earnings is good for quarter two, but doesn't necessarily mean quarter three earnings is going to be better, especially if they're considering doing a slowdown in employment and maybe layoffs in the future. Okay. Now, overall big picture though, the big picture, don't forget, since the beginning of the year, after hitting a record high in January, the S&P 500 has fallen by 13%. I know I said it rose 30% from the lows it hit in June, but overall from the year, from the high end it hit in January, it's down 13%. Anyway, let's have a quick look at the market. Let's look at the S&P now 500 and see what we're looking at. This is on a 30-minute chart. Okay, this is on a 30-minute chart. And then we'll look at a bigger picture on a daily. Now, this is why, and of course, we're going to talk about tomorrow as well. Now, as you can see, the market had that sort of reality because of the good job market number. Okay, it spiked downwards because obviously the good job market was a lot better than expectations. Sorry, excuse me. The market straight away assumed, the Fed's going to be aggressive, so they're pricing it in at that moment. The Fed's going to be aggressive, but then after that, we had a little bit of a bull run until obviously yesterday we had the NVIDIA and Macron saying about earnings. We can see the S&P's come under pressure, and currently it's now trading at 4,120 points. Okay, 4,020 points. So it's lower for the day so far. If we look at it in a daily, Okay. All right. This was obviously the low of June. As you can see, it was a huge lot of pressure on the S&P, and then it hit its low, and it started to recover. And this is where I think this is a bear market rally. Okay, it's totally at the moment it's facing a key area of interest of 4,190 points. Okay, and yeah, there's a bit of buying around the 4,900 level, 4,099 point level, obviously, which is obviously a bit of optimism. Not optimism, that's where there's a bit of buying in. Obviously, the 4,000 point level is obviously psychological level. So that's where I see it. I see that this is a major stumbling block for it, potentially. And I do really generally beginning to think that as it stands at the moment, this is a bear market rally, which the market's not sort of preparing itself for. If we have to look at the NASDAQ as well, the NASDAQ is opened. This is on a daily, but if we look at 30 minutes, we can see it a little bit quicker. As you can see, the NASDAQ is also under pressure. That's also recovered since June. But again, I think this has experienced a bear market rally as well. So yeah, that's where I see it at the moment. Okay, currently trading at 12,971 points. So again, my point being, all I'm trying to say, and it's an open forum. So if you agree with me, you agree with me. If you don't, you don't. I'm not saying that I'm right. Nobody ever knows for certain. But I'm just thinking, I think the market's putting itself to a false sense of security. And I'll talk a little bit more about that in a minute when we talk about the big event happening tomorrow. On other news, oil has bounced slightly again today on supply concerns again. Remember, a couple of trading sessions ago, I said it wasn't about supply at the moment. It was about about the fall in growth or fall in demand. It was more a demand issue. Well, supply issues arose again slightly. The reason being, I'm not going to be able to pronounce this properly. The Duzaba pipeline, which connects Russia, runs through Ukraine and goes into Europe, has been suspended. And it actually has been suspended since August. Once again, reducing supply to Europe. Now, don't forget when the EU did their block on Russian oil imports, it was by ship or by boat. It wasn't by pipeline. So they allowed the number of the pipelines to continue to supply oil. That's one of the things they had to do to get Hungary on board with the deal. And this is back, 2 months ago. So the fact that it's suspending the pipeline again is a big, again, it's raising the fears of supply once again. And in fact, just on the back of this, oil was being pressured, yesterday due to encouraging talks with Iran over Iran's nuclear program. Don't forget, because of sanctions about the nuclear program, Iran is limited to how much they can export of their oil. So if they can remove this sanctions and come to some agreement, then again, boom, the taps are back on for Iran, so we'll have more supply again. So that's another thing, weighing on oil. But for now, oil has ignored that and it's focused a little bit more on this other pipeline being shut down, which connects Russia to Europe, going through Ukraine. Let's have a quick look at oil as it stands as well. Okay, this is where it is at the moment. Like I said, yesterday, earlier, it's on a daily. We go in 30 minutes, we can see it a little bit more in the short term. Okay, like I say, remember it's trading under this key level we were watching at the point before this this news of this pipeline, 89.54. It since has spiked up almost $2, no, but $1 and a bit higher. It's currently trading now at $91.17. Again on the supply issue. Again, Brent is the same, currently trading higher at $97 now and 55 cents. So yeah. There we go. Right. The rest of the market, what it's doing. And in many ways, it's treading water. And that is because, obviously, the market is waiting for the big day tomorrow. The big thing tomorrow, which is, of course, the all-important US CPI tomorrow. Expectation is for it to come in at 8.7%, which is slightly lower than the 9.1% previous. Okay, but this is the big thing which the market has been waiting for the last two trading sessions since yesterday, and since the NFP number came in at 528. versus 250 expected. This is the thing. This is the thing they're waiting for. And this potentially, depending what it comes in at, if it comes in at 8.7%, we will see that maybe inflation has peaked. I don't think it has, in my personal open opinion. I don't think it has peaked yet, but we'll have to see. Or will it, shockingly, come in higher than 9.1, like the UK's did? So that's a big thing. If it comes in as expected, maybe slightly higher, or if it comes in as a shocker, then the market is clearly going to think the Fed is going to be aggressive and do 75 basic point rate hike in September. And Citibank, like I said this morning, they're even saying if it's a real high reading tomorrow, a real high reading, the Fed may do 100 basic point rate hike in September. And then the market will then maybe start to feel, and that's when we might see the end of this bear market rally, may start to feel the Fed's going to be very aggressive with interest rates. And we start to see pressure and dollar strength. Because of this event, it's the big event. It's the real big event this week. I will be doing a watch along, obviously. And I will be going live tomorrow at 12:20 p.m. UTC. Please come and join me for that, because I think it's going to be potentially a real big event, which we could see, we could potentially see a lot of volatility in the market. So please come along and join me for that. It should be it could be a real big event. And like I said, the markets are waiting for that. That's what the markets are waiting for at the moment. That's what they're waiting for right now at the moment. In fact, let's have a quick look and see what the market is doing. Let's look at some currency pairs now. Let's look at the euro. Okay, it's 30 minutes. Okay, it has spiked up as slightly higher from the beginning of the morning. It's not anything dramatic though. If you look at it on a daily, we can see a bigger picture of it. It's still fairly tepid, fairly sideways. It still has that key level of 1.02684 to break before it can be properly known as bearish. It's still under the 50, the 100, and the 200-day moving average as well. So it is still trading between 1.2068 as a key area of interest and 1.00761. If we have a look at the dollar yen, okay, it's really just about trading above that key level, 134.70, currently trading at 135.101. But again, like I say, it's still hovering around 135. Nothing terribly dramatic at all. It's just been very, trading the water, like I say, because it is going to be waiting for tomorrow. Cable, British pound, US dollar, same picture, currently trading at 121.19. Still trading between those two key areas of interest, 121.976 and 1.20034. And finally, we have a look at gold. Again, this is on a daily, so we can capture what the daily movement has generally been. Still hovering around that key level, 1,791. Again, waiting for tomorrow, which, like I say, potentially could be huge. Right, on other events this week, again, really, it's all about the US CPI. But hey, we got the German CPI tomorrow. Expectation is 7.9%, I believe it is. US initial claims. Remember, I've been looking at that, and it's been seen as steady growth. UK GDP, which is supposed to come in negative, and a negative reading, and US Michigan sentiment. How the European equities currently stand. FTSE is currently trading 0.07% higher. DAX currently trading at negative 0.94% higher. And Euro Stock 50 currently trading a negative 0.75%, negative 0.75% lower. So that's how it stands. Like I said, it'd be interesting. Well, the CPI tomorrow, if it comes in a lot higher than anticipated, will we start to see the end of this bull market rally, which started basically near the middle of June? Are we going to see the end of it, or are we going to see a bit more of it? So it'll be interesting to see, because like I said, I really do think the market is kidding itself that the Fed is not going to be aggressive. And like I said before, we haven't yet seen the impact of this tightening yet. We haven't seen the proper impact of it on mortgages, on how companies are going to be able to pay their loans either. So it's going to be a big event. And like I say, please come and join me for it. It's 12:20 p.m. tomorrow, UTC. Tixee Live, watch along, USG CPI. And this is the event the market has been waiting for all week. And luckily, we're almost there at it. Almost there, at it. Don't forget, you can ask me questions anytime you wish, or just simply say hello if you like, or share your opinions on the matter and tell me what you think, whether or not you agree with me or you don't agree with me, or, please, it is a live broadcast, and live does mean live, obviously. So feel free to ask me anything, or simply say hi if you like. Don't forget, as well as that, if you think of a question later, jot it in the comments below, either on Facebook or YouTube. I will read them, and I will answer the question next time I'm live on air. So do bear in mind, you have that option too for you. So do bear that in mind. Okie dokie. All right. Don't forget, I'll be back on again tomorrow at 8 a.m. UTC. And tomorrow morning, I will obviously be doing a big preview of the US CPI. Then I'm back on again at 12:20 p.m. UTC to do the live watch along of the US consumer. Oh, bless. Not to worry. Don't worry about it. Nice to see you, mate. Thank you for coming. I was going to say, and I'll be doing the live watch along of the US CPI, 12:20 p.m. And of course, I'll be back on again in the afternoon to cover the US session, talk more about the announcement, and we'll look at the impact on the market together after the market's had a couple of hours to digest it. We'll be back on again around about 4 p.m. UTC to discuss that too. So bear that in mind. On that note, what I will say, if you're watching me on Facebook and you enjoyed this little episode, the unemployment figure in CPI, or the unemployment as in the 3.5% we had from the US, does the unemployment figure affect this? Obviously, higher unemployment, the more strain it does on the markets, obviously, because there's less people earning taxes and having money to spend. And at the same time, it's more of a burden on, obviously, the government. So unemployment, the higher the unemployment figure, it can really have a negative impact. But at the moment, the labor market, from the US, from the labor market at the moment, the US is 3.5. So it is quite robust at the moment. But let's see, again, obviously, tightening may affect this, because, like I say, it's costs for not personal loans, but it's corporate loans. So if companies are struggling with their overall costs, they might have to let people go in the medium and long term. So this can affect the labor market in quite a big way. So you've got to bear that in mind as well. But good question. Very good question. Like I say, right, what I was going to say, if you're watching me on Facebook and you enjoyed this little episode, by all means, give us a follow. And if you're watching this video on YouTube and you've enjoyed it, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video, found it useful, and you've put up with me, my over-the-top enthusiasm for the markets, which I just can't help because I love the markets, then give me one of these. It's nice to know that you like what I do. I can see I've got a like already. But anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should it be taken as financial advice. I always suggest you do your own research and do your diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.